Hi guys, my name is Castro. Welcome to another episode of my channel. If it's your first time here, kindly subscribe. Leave the notification bell on so that whenever I post such a video again, YouTube will automatically notify you. Otherwise, you feel welcome. In our today's episode, we're going to look at 5 legal ways in which one can reduce his or her tax obligation in a common practice known as tax avoidance. Tax avoidance is basically exploiting the tax system to find ways in which one can reduce the amount of tax they pay. Tax avoidance is legal in Kenya since it is often done by witty taxable persons or entities who take advantage of the loopholes in the tax system so as to reduce the amount of tax they pay. The main aim of tax avoidance is to reduce the amount of tax payable and also maximize on the returns and income. So point number one of how one can legally avoid paying taxes in Kenya is by taking up a mortgage instead of an ordinary loan. A mortgage is basically an agreement with a financial institution that allows you to borrow money to purchase a property. With mortgage, the law allows you a tax relief claim of up to 25,000 Kenyan shillings per month, or equivalently to 300,000 Kenyan shillings per annum. So if you plan to buy a property, it's advisable for you to take up a mortgage instead of an ordinary loan. This is because an ordinary loan do not attract a tax relief claim. Point number two is to investing in tax-free environment. There are so many tax-free environments or vehicles that you can put your money into. Example of such is investing in infrastructural bond. Infrastructural bond is a type of bond where you loan your money to the government, and the government in turn uses the money to develop infrastructural projects. The returns generated from the infrastructural bond are usually exempted from taxation. Another example of tax-free environment is by investing in a fixed deposit account with the Post Bank of Kenya. The interest generated by the fixed deposit account from Post Bank is also tax-free. This is because Post Bank of Kenya, unlike other commercial banks, is not regulated by the Central Bank of Kenya, but by the Kenya Post Office Bank Act. Point number three of how you can legally reduce your tax obligation is by registering with the retirement benefit scheme. Other than the National Social Security Fund, which is mandatory for salaried employees, there are so many retirement benefit schemes offered by various financial institutions which you can register to be a member. Savings with these retirement schemes of up to 20,000 per month or 240,000 Kenyan shillings per year are usually exempted from tax. In addition, investing in these schemes also attract an interest on your deposit of from approximately 4 to 7% per annum. The fourth point of how one can legally avoid paying taxes in Kenya is by getting a disability relief. Persons living disability in Kenya are assessed by the government medical institutions. Upon the assessment report, the National Council for Persons Living Disability registers such a person. So if you are a person living with disability, by virtue of this registration, you can apply for a tax exemption certificate from the Kenya Revenue Authority. In Kenya, PWDs are exempted from taxation with taxable income ranging from 150,000 Kenyan shillings per month to 1.8 million Kenyan shillings per annum. So if you're a person living with disability, you should take advantage of this tax exemption certificate so as not to miss on such huge saving. The last point is to contribute to a registered home ownership saving plan. This is a plan by the government to enable its citizens to own their own homes. With such a plan, you dedicate a portion of your monthly income to such contributions. Contributions ranging from 4,000 Kenyan shillings per month to approximately 48,000 Kenyan shillings per annum are exempted from taxation. In addition, the interest generated from these contributions are also tax-free. So that's all I had for you today. Thanks again for watching. See you next time.